Currently, we are in a very positive environment for distressed asset transactions, as there have been record amounts of capital raised by funds that capital needs to be deployed now, which means there's a lot of demand driving up prices through more competition for what still is limited supply. There are some sectors, for example energy, where there clearly is enough supply, but in other sectors and more specific assets, you're still having to source specific situations carefully and find also the right buyers to really match and successfully transfer an asset. If you are considering today to selling your distressed assets, be it a bankruptcy claim, be it a portfolio of private equity funds or single funds, we clearly see that the current market environment is very favorable in terms of pricing, but also then appetite for a broad range of illiquid and or distressed assets. The market for distressed assets is clearly segmented geographically. For example, in the US, the market is more evolving around restructuring, Chapter 11 type situations, whereas in Europe, the topic in distressed assets clearly is still very much centered around NPLs, so-called non-performing loans, having to do with a less efficient banking sector reinventing themselves. They're still having to offload large amounts of asset pools, but that happens gradually and it happens with different speeds in different countries. But it's quite fair to say that in Europe, the whole process has been going much slower than in the US. Pricing is an interesting topic, given the market for distressed assets being very heterogeneous and also very opaque. Pricing varies greatly depending on what specific types of assets you're looking at. For example, in private equity, you have a very established and competitive market with many participants. You have a very almost transparent structure in the transactions. You know which players are looking at what types of funds. The market can almost be considered liquid, whereas in other sectors that are more complex to transfer, in situations that are more difficult to assess, where outcomes are, let's say, more binary, pricing has developed positively. I think as a generalization in the distressed asset space, with target IRRs demanded by the different investors coming down. That is a result of two factors. One being there is more demand for few deals, and second is a development that the investment banks as such are starting to lend against illiquid and distressed assets again, meaning that you can still generate an attractive return if you use leverage to finance particular deals. However, it also needs to be said that you have very different categories of distressed assets with, for example, some investors looking purely at non-performing loans, whereas others focus more on single name restructuring, bankruptcy and or turnaround situations. What we also see is that we've been observing is, let's say, rather mediocre or disappointing performance of different private equity and distressed hedge funds, which is a strong indication that they would have paid too much in order to acquire these assets, thus generating the lower returns. There is demand for smaller positions below the 1 million or even 100,000 threshold, and that's a space that we want to actively occupy, providing a good market in, as we want to differentiate our activities exactly into that segment. That is a segment where we believe the market is less efficient, as many of the large players don't look at small transactions, and hence we find this quite an interesting space for us to occupy. There is some situations where a single position would be too small to trade. It depends on how it is held, how it is structured, but we often also then simply advise a seller to package together different types of smaller illiquid pieces into a portfolio, for which again you would find a buyer in the market that has an appetite for this type of asset pool.